Welcome to the world of trading. When you first look at a price chart, you see a line that goes up and down. It can seem random and confusing. How can anyone possibly know where the price will go next? While no one can predict the future with perfect accuracy, traders use special tools to help them make better decisions. These tools are called technical indicators. They are mathematical calculations based on an asset's price, volume, or other factors. Think of them as your assistants, helping you understand the story that the chart is telling. They help bring order to the chaos of price movements. Indicators are not magic crystal balls. They do not guarantee that you will make a profit on every trade. Instead, their purpose is to provide you with more information and a clearer perspective. They help you analyze past price action to identify patterns and potential future movements. By using indicators, you can develop a structured approach to trading. This is much better than simply guessing or trading based on emotions like fear or greed. Using these tools helps you build a consistent strategy, which is one of the most important steps toward becoming a successful trader. There are many different types of indicators, and each one serves a specific purpose. Some indicators are designed to help you identify the direction of the market's trend. Is the price generally moving up, down, or sideways? Other indicators are built to measure the momentum or the speed and strength of price changes. They can tell you if a trend is getting stronger or if it might be losing steam and preparing to reverse. By learning about a few key indicators, you can begin to see the market in a whole new way, gaining insights that are not obvious from looking at price alone. In this guide, we will focus on two of the most popular and useful indicators for new traders: moving averages and the relative strength index, or RSI. These two tools are a fantastic starting point because they are easy to understand and provide very valuable information. Moving averages will help you see the underlying trend more clearly, while the RSI will give you clues about the market's momentum and potential turning points. Learning to use them together can form the foundation of a simple yet powerful trading strategy that you can build upon as you gain more experience. Let's start with moving averages, often called MAs. A moving average is one of the most fundamental trend-following indicators available to a trader. Its main job is to smooth out the day-to-day price fluctuations on a chart. Imagine trying to see the main direction of a winding road from very close up. You would see every little turn. A moving average is like looking at that same road from a helicopter. It filters out the noise of small, insignificant price spikes and dips, allowing you to see the broader, more important trend with much greater clarity. It does this by calculating the average price over a specific number of periods. There are two main types of moving averages you should know about: the simple moving average, or SMA, and the exponential moving average, or EMA. The simple moving average is the most basic form. It calculates the average price of an asset over a certain number of periods by simply adding up the closing prices for those periods and dividing by the number of periods. For example, a 20-day SMA is the average closing price over the last 20 days. It gives equal weight to all prices in the period, making it a very smooth but sometimes slow line. The exponential moving average, or EMA, is a little more advanced but very popular. Like the SMA, it calculates an average price, but it gives more weight to the most recent prices. This makes the EMA react more quickly to new price information than the SMA. Because of this responsiveness, many short-term traders prefer using EMAs. They find that the EMA provides a better reflection of the current market sentiment. When price starts to change direction, the EMA will often turn sooner than the SMA, potentially giving you an earlier signal to enter or exit a trade. Traders can set moving averages to any time period they want, but some settings are more popular than others. For shorter-term trends, many traders use the 20-period EMA and the 50-period EMA. The 20 EMA provides a good look at the short-term trend, while the 50 EMA shows the medium-term trend. When the 20 EMA is above the 50 EMA, it is often seen as a sign of a healthy uptrend. When the 20 EMA crosses below the 50 EMA, it can signal that the trend is shifting downwards. These are simple but powerful visual cues on your chart. Now, let's talk about our second assistant, the Relative Strength Index, or RSI. While moving averages help us identify the trend, the RSI helps us measure the momentum behind price movements. Momentum is the speed and strength of price changes. Think of it like this. A car can be moving forward, but is it accelerating and gaining speed, or is it slowing down and preparing to stop? The RSI helps us answer this question for market prices. It is known as an oscillator because it moves back and forth between two extremes, providing signals about the market's internal strength. The RSI is displayed as a single line on a graph, and its value moves between 0 and 100. This scale makes it very easy to read and interpret. The indicator measures the size of recent price gains against the size of recent price losses. When the RSI line is moving up, it means that the upward price moves are becoming stronger than the downward price moves. Conversely, when the RSI line is moving down, it suggests that the downward price moves are becoming more powerful. This helps you gauge whether the bulls or the bears are currently in control of the market. The most important levels to watch on the RSI are 70 and 30. When the RSI moves above the 70 level, the asset is generally considered to be overbought. This does not automatically mean the price will fall, but it serves as a warning. It suggests that the price has risen very quickly and might be due for a pause or a reversal. An overbought condition indicates that the buying momentum might be getting exhausted. It's a signal to be cautious if you are thinking about buying and to perhaps look for signs of a potential top forming in the market. On the other side of the scale, when the RSI falls below the 30 level, the asset is considered oversold. This is a signal that the price has fallen very fast and that selling pressure may be running out of steam. An oversold reading suggests that the asset could be undervalued and might be ready for a bounce or a reversal back to the upside. It's a caution flag for anyone who is selling short and a potential point of interest for buyers looking for a bargain. The RSI helps you identify these extreme conditions where a trend might be ready to turn. The real power of technical indicators comes from using them together. No single indicator is perfect, but by combining their signals, you can build a more complete picture of the market and increase your confidence in your trading decisions. A fantastic combination for beginners is using moving averages to define the trend and the RSI to time your entries and exits. This strategy helps you trade with the main flow of the market while identifying lower risk opportunities within that flow. It's a simple yet effective way to structure your analysis. Here is a practical way to use these tools. First, use the moving averages to determine the overall trend direction. For example, if you are looking at a daily chart, you can put the 20 EMA and the 50 EMA on it. If the price is trading above both moving averages and the 20 EMA is above the 50 EMA, the primary trend is up. In this scenario, you should only be looking for opportunities to buy. This simple rule helps you avoid the common mistake of trying to fight the trend, which is a difficult and often losing battle, especially for new traders. Once you have confirmed the uptrend with your moving averages, you can turn your attention to the RSI for an entry signal. Since you are in an uptrend, you are waiting for a temporary pullback or a dip in price to buy at a better value. You can watch the RSI for this opportunity. When the price pulls back, the RSI will likely drop. You could look for the RSI to dip near the 30 level, indicating an oversold condition within the larger uptrend. This signal suggests that the pullback might be ending and the primary uptrend is ready to resume, offering a good potential entry point. To finish, I encourage you to start practicing. Open a charting platform and add the 20 EMA and the 50 EMA to a chart of any stock or currency pair you're interested in. Then, add the RSI indicator in a separate panel below the price. Simply watch how the price interacts with the moving averages. Notice how the RSI moves up and down, and pay close attention to what happens when it reaches the 70 or 30 levels. This hands-on observation is the best way to develop a feel for how these powerful assistants can guide your trading journey.